Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're here to talk about a topic that I haven't covered before, but we've done bits and pieces in other types of educational sessions. But today I want to talk a little bit about trading neutral and choppy markets. We've gotten a lot of choppy markets in the last few months. I want to talk through some of the option strategies to trade and profit from these types of choppy or neutral markets, something that you can't do as an equity investor or trading other types of asset classes to profit from a market that's moving sideways. So how you can do that utilizing options, but also I want to talk through how do you identify a neutral and choppy market? What are some of the best practices in terms of looking for opportunities on stocks that are moving sideways? Because I do think that it is somewhat counterintuitive to identify them. And many times I see investors who tell me they've identified a choppy or neutral market. And I actually think that is probably the worst time to trade some of these overall strategies. So today I want to break down all of that and get into this. So before we get started, what we are going to discuss is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that we are discussing during today's session. So I want to start off by talking about identifying neutral markets, because I think this is really important. Unfortunately, I see a lot of investors that ask me, do I think now is the right time to trade iron condors or short straddle? Most of the time when someone asks me that question, I actually think those are probably the worst times to trade these types of strategies. So I want to talk a little bit about why I think it's the worst time and some of the data behind it. And more importantly, how do you go about finding the right times to trade these types of, or identifying these neutral markets? We'll talk about a few different types of strategies. We'll talk about credit spreads as a simple strategy. We'll talk about straddles and strangles, which is a more advanced strategy. And then we'll talk about iron condors, which is really a bit of a better version sometimes of selling a strangle, or at least a strategy that has lower amounts of risk. Then we'll talk a little bit about my trading tips on these types of strategies before we open this up for Q&A here at the very end. So but the primary thing that I want to help you walk away from today's session is a clear understanding as to how do you identify a neutral market and how do you profit from it using an options strategy. So before we jump into it, how many of you currently trade some form of a neutral strategy? Type yes into the chat window if you do, and please type no if you don't. And if you no, might be because you only trade directional strategies, stocks that you think are going to make a big move. And yes, if you do seek these types of neutral strategies. Okay, I see quite a few yeses, but I actually see a significant number of no's. So meaning a lot of you may not be utilizing these strategies. So hopefully, for those of you that answered yes, this is hopefully giving you a clear understanding as to how I identify neutral markets, but number two, a review of the strategies. And for those of you that said no, hopefully this expands your opportunities that you trade with options. So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And what I want to share with you is really 16 years of technical analysis experience that has led me to identify what I believe are indicators that determine when a neutral market is likely going to take hold, and when are actually the wrong times to trade a neutral strategy. So let's first start off by taking a look at a chart. And what I have here is a chart of Apple over the last year or so, and a few different times where we've had somewhat of a neutral market, when the market basically is trading sideways for about a month's worth of time. Each one of these spans about a month, sometimes a little bit longer here. But when we talk about a neutral or choppy market, we usually try to identify these over roughly a month to 2 month time span, because those are the times that you'll be able to trade these types of option strategies. And unfortunately, most of the time I get questions from people asking, hey, is now a good time to trade an iron condor or a straddle or short straddle or strangle? It's usually around this time. meaning they've already spent some time noticing that the stock has been range bound for quite a period of time. They've identified a support or resistance level. And now that they've identified that support and resistance level, the idea is that, okay, this stock will likely trade in this range. So let me sell an iron condor that will take advantage as long as the stock stays within this range going forward. Unfortunately, I tend to find that that's the worst time to sell an iron condor, because once a stock has been trading in a range for quite some time, it is more likely to break out one way or another. And that's usually what happens is once you've identified a trading range, it's usually too late to sell an iron condor or sell a straddle. How many of you can understand that? Please type 1 into the chat window if that makes sense to you. And if any of you, have found yourself in that position where only after you've identified a period of a range, then you've sold an iron condor, please type 2 into the chat window if you can identify that or have done that in the past, okay? So what I want to do is I want to be clear as to first identifying when is generally, in my experience, the wrong time to sell an iron condor, and then we'll come back and discuss what I think is the right time to sell an iron condor. But again, once you've identified a range, chances are it's too late. The stock will likely break out from that range once you've identified that range. So what we tend to find is that stocks tend to trade sideways after a large outsized move. So it's basically the exact opposite. Usually what we tend to find is when the stock makes a big move to the upside or a big move to the downside, after that, you have a period of consolidation. And that is usually a much better indicator of a neutral market that's to come. Now, that doesn't mean that it always happens, but what I've noticed over the past 16 years of trading is that these neutral sideways markets tend to happen after the stock makes an outsized move in one direction or another. Does that make sense? Please type 3 into the chat window if that makes sense to you. And what we're trying to do here is that ultimately there's no single indicator that's going to tell you that the markets are going to move sideways. But what we want to do is we want to put probabilities in our favor. And this is really where technical and statistical indicators can be used to help us determine when there has been an outsized move. So, a really, I would say, commonly used technical indicator is average true range. Some of you like to use ADX. They're all kind of derivations of the same type of statistical technical indicator. But essentially what they do is they give you a sense for how much the stock has moved compared to its history. And what I tend to find, again, is that once you've identified a trading range has been established, it's usually too late at that point because it's more likely that the stock is now going to break out from that range, which is, again, the worst possible time to trade one of these neutral strategies. So just to go back to this chart here before, what I have here on the bottom panel below Apple is the average true range of Apple. And what you tend to find is that these neutral moves, when we spend about a month and a half in a sideways motion, they tend to come after you get peaks in the average true range. When you get these relative local peaks in the average true range, that is when you tend to have these neutral sideways movements. Now, average true range it's not based on a percentage, it's based on the dollar amount, and that's why it's hard to make these comparisons. But so what you want to do is you want to look at relative peaks. When the stock makes a relative peak and starts to come down in terms of average true range relative to its history, those tend to be higher probability attempts at moving a sideways market. And that's exactly where we are right now. As you can see, the average true range here for Apple is the highest we've seen since September of 2020. So we could potentially be entering an opportunity for Apple to start moving sideways. And we've already started to see some sideways action after what has been a large outsized move here in Apple. We haven't seen average true range start to turn, I apologize. We haven't seen average true range start to turn lower yet, but once we start to see that turn lower, we can start thinking about these types of neutral, choppy markets. Does that make sense? Please type 4 into the chat window if that makes sense to you. Perfect. And, for those of you that have, different scanners, different types of platforms, you can scan for ATR and see where, where ATR is trading at 1-year highs or, 6-month highs. Those are good candidates to potentially start looking at this. I happen to have found Apple here today trading at 1-year highs in terms of its average true range. That's telling me this move here, the move that we've seen here, is outsized. It's larger than any of the moves we've really seen here over the past year or so. And that's a good condition for it. ATR stands for average true range of the underlying stock. It's a technical indicator that pretty much most charting packages have. So that's how you go about, first of all, identifying the conditions for trading or for the conditions that can lead to a neutral or choppy market. And again, that doesn't mean it always happens to be the case, but it's a better indicator than once you've identified an actual trading range. So there is some, I would say, speculation there, right? Because you don't know if a move is about to turn sideways or not. So that's really where the combination of looking at ATR, looking at price action. Notice how over the past week or so, Apple has been really range bound, hasn't moved much more beyond 172, 180 or so. It's been in that range. This is a good potential start of what could be a sideways choppy market, especially if ATR starts to turn lower here. So let's talk a little bit about the option strategies you can trade for a neutral market. And this is really where we turn to credit spreads. Credit spreads is the simplest, I would say, and the least risk strategy out of all of the ones that you can use to trade a neutral strategy. And you can trade a bullish credit spread or a bearish credit spread, depending on where you are within that trading range. So if you're near the top end of the range, meaning if, let's say we're back towards 180, you might want to sell a call credit spread. And if we're near the bottom end of the range around 170, you might want to sell a put credit spread. And effectively what you're trying to do is you're playing the range, right? If it's near the top, you're basically expecting it's going to bounce lower. If it's near the bottom, you think it's going to bounce higher. So does that make sense, using credit spreads to play a range? Please type 5 into the chat window if that makes sense to you. Perfect. Okay, so it sounds like a lot of you are getting it and following along, but let's just clarify when we talk about credit spreads. The general rule of thumb, and I have videos on credit spreads alone, and you can go and watch them if you want, but the general rule of thumb with credit spreads is going out about 45 days to expiration and selling an at-the-money strike price and buying a 25 delta strike price. So when Apple's are trading around 174.86, we're going to sell the at-the-money, which is the 175, and we're going to buy back the 190, which is the 25 delta. Those two strike prices 45 days out is your optimal credit spread. And the goal here is to collect a minimum of 1/3 of the distance between the two strike prices. So the distance between 175 and 190 is $15. 1/3 of $15 is $5. In this particular case, we're collecting $5.30. So we're collecting more than 1/3 of the vertical lift. That is the general rule of thumb of selling a credit spread. So in this particular case, I'm collecting $5.30. That's more than 1/3 of $15. This satisfies all the requirements for potentially selling a credit spread here on Apple. Now, I will say, Apple's right now is not in the top end of the range. So from a tactical timing perspective, this isn't the best strategy. You really want to wait in terms of timing so that when you want to wait for the stock to be either near the top end of the range or the bottom end of the range, that would be the best possible time to time that strategy. Because if you're near the top end of the range and the stock immediately rolls over, you can take profits a little quicker and make your profits faster. Does that make sense? Please type 6 into the chat window if that makes sense to you. And many times, one thing I want to note here is that when we talk about a trading range, right? What I'm drawing is the range that we have seen after the fact. Many times you might identify a range that's slightly narrower than the actual range itself. So it's very common that initially when you draw the range, you do have stocks make small piercings above that range and come back in, or pierce below that range and come back in. So just be aware of that. So you might identify a range that's fairly small, but the stock will actually end up breaking out above it and coming back. And many times that will happen. So here I think is probably a good example where the stock breaks out of the range and comes back in, and breaks below the range and comes back in. So this is really where limited risk strategies help you stay in these trades, and you don't get shaken out by the intraday moves, if you will, sometimes, or the intra-week moves. When you trade strategies with limited risk, you know that even if the stock goes significantly above your trading range, you have limited risk. You're more likely to hold on to that trade through some of that volatility to hopefully let it come back in and for you to profit. So that's really why, the strategies that I want to discuss first, the credit spreads, are limited risk strategies that hopefully help you sit through some of that volatility, because these neutral strategies does require you to sit through that volatility. Does that make sense? Please type 7 into the chat window if that makes sense to you. When the stock moves a big move out away from where you're expecting the trading range, the limited risk strategies help you kind of control your risk versus some of the unlimited risk strategies. You might be sweating it through some of those moves outside of the range, and they might just come back a day later. But if you're trading an unlimited risk strategy, you might be concerned, you might cut your losses early. These limited risk strategies, I think, are a great way for beginners to trade these types of strategies and feel comfortable sitting through some of the volatility, okay? So as far as credit spreads go, we also publish a credit spread opportunity report. And you can do this using the OptionsPlay tool that gives you both the symbol and the direction, the credit spreads itself, the risk to reward, meaning how much of the vertical width you are collecting. Like I said, we want to collect a minimum 1/3, but our report helps you find ones that collect closer to 40%, sometimes even a little bit more than 40%. And this is a report that's updated every single hour. And you can find it using the OptionsPlay tool. When you click on the education and resources section on the upper right-hand corner of your platform. When you click on the education and resources section, it will take you to the OptionsPlay hub, which will give you access to both the credit spread opportunity report as well as the short at the money straddle and strangle report. Both of these we will cover here today during our session. But the first one, the credit spread opportunity report, gives you opportunities to find and collect these credit spreads. And it gives you not only the symbol, the direction, but also the strike prices that you can buy and sell. And you can simply click on a single one to view the trade within OptionsPlay. This is designed to help make your workflow as simple as possible, from idea to analysis within a few seconds, so that you can quickly see how much you're collecting, how much you can potentially make, what your risks or rewards are, make that decision relatively quickly, and be able to place a trade in a few seconds. You'll be able to click that using the OptionsPlay tool. So this is the opportunity report that you can find on your OptionsPlay hub, which again, for those of you that have an OptionsPlay account, it's in the education and resources section here on the upper right-hand corner of your platform. And I'll just pull up Apple here real quick, and I'll take a look at Apple right now because we're trading near the bottom end of this range. So maybe let's take a look at the bullish credit spread instead of the bearish credit spread here. Like I said, we want to set up about a 45-day at the money credit spread. So it's currently trading at 172.26. So the at the money puts the 172.5 puts. To buy the 25 deltas, the 25 deltas you can see is the 160 strike price. As you can see, 0.26. That's how I know the 25 delta. The 160 is the closest to the 25 deltas. And as you can see here, what I'm collecting is $4.75 on a credit spread that's $12.50 wide. The distance between these two strike prices, 160 and 172.5, is $12.50. So 1/3 of that, let's do a little quick math here, 1250 divided by 3 is $4.16. So 1/3 of $12.50 is $4.16. That's 1/3. In this particular case, we're collecting $4.75. So fairly significantly above 1/3 of the vertical width. So this is really where I look at this trade. We're trading near the bottom end of the range. So I would be more inclined to sell a put vertical spread than a call vertical spread because we're near the bottom end of the trading range. Does that make sense? Please type 8 into the chat window if that makes sense to you. Perfect. Okay, so let's talk a little bit about credit spreads and managing these spreads. So when we talk about managing credit spreads, there's really three possible triggers to exit one of these credit spreads. Either you take a profit at 50% of the max gain, you take a loss at 100% of the max gain, or you get out of the trade at 21 days to expiration. And I'm going to walk you through these three triggers. But the rule of thumb is if either one of these three triggers, whichever one triggers first, that is your signal to exit the trade. So just to give you an example, if let's say I'm selling a credit spread that's $3 wide. So let's say I sell a credit spread that's, I sell a $33 put and I buy a $30 put. That's a distance between those two strike prices is $3. That's a $3 wide credit spread. And let's say I'm collecting $1 for that credit spread. So out of the $3, I'm collecting $1. Where I want to take profits is if the $1 credit spread that I sold is now only worth 50 cents. If I sold something for $1, that's now only worth 50 cents. That means I've made 50% of the full max gain because whatever I collect in my credit, that's the most I can make. The $1 is the most I can make. If I make 50 cents of that, that's half of what I can make. Then it's time to take your profits and move on to the next trade. Does that make sense? Please type 9 into the chat window if that makes sense to you. Perfect. And if let's say I sold something for $1 and it starts to go in the opposite direction, now this $1 credit spread that I sold for $1 is now worth $2. Well, if I sold something for $1 and it's now worth $2, I've now taken a $1 loss on that trade. Now, a $1 loss on a trade where the max gain is $1 means I've lost 100% of what I can potentially make. That's 100% of the max gain. So if something I've sold for $1 is now trading at $2, that's a time to start cutting your losses and getting out of the trade. Does that make sense? Please type 1 into the chat window if that makes sense to you. And sometimes you sell a $1 credit spread and it doesn't hit your take profit or your stop loss level, but the trade gets to 21 days to expiration. Now, this is also a rule from my perspective to cut your loss, to get out of the trade. It doesn't matter whether you're making money or losing money on the trade. Once your trade gets to 21 days to expiration, get out of the trade. And it really comes down to trying to avoid expiration and exercise risk. Because when you sell a credit spread, you don't want to end up owning the stock or being short the stock. And if you hold the credit spread into the last 21 days, into the last 3 weeks, you have elevated risk of having early assignment and being exercised on that particular trade. So the rule of thumb is to exit the trade at 21 days to expiration. You can always enter a new 45-day credit spread. That removes the early assignment risk. So always, if you don't meet the stop loss or take profit rule at 21 days to expiration, you should have a rule of thumb of closing out the trade either for a small gain or loss, and then you will be able to roll that trade into the next 45-day trade. So next, what I want to talk about is a more advanced strategy. So the credit spread is a strategy that is suited for someone who's more new. Many of you at the beginning of the webinar mentioned that you've never traded a neutral strategy before. If you've never traded a mutual strategy before, start with credit spreads. It's a limited risk strategy. It's easier to understand first time. For those of you that have traded neutral strategies, a more advanced strategy is a short straddle and a strangle. And this strategy has, for many people, a huge disadvantage. And it's the fact that this strategy has unlimited risk. It's one of the few option strategies that truly has unlimited risk. And it has unlimited risk because the stock can, in theory, go to infinity. And when you're short a straddle or a strangle, you effectively have that short strategy. So you've all seen how much a short position in GameStop or AMC lost when the stock shot up from $40 to $400. There's no limit as to how much money you can lose. And when you're short a straddle, you have that same risk of being short the stock. So this is a strategy that a lot of traders do not touch because of this unlimited risk strategy. But I still want to discuss it because for those of you that have a larger portfolio, for those of you that trade enough options, this is definitely a strategy you should still consider. And I want to walk you through the scenarios because you might be surprised at just how far the stock needs to move before it, you really have some big losses. And you would be surprised, and we're going to use Apple here as an example, but just to show you a straddle or a strangle is typically going out about 45 days to expiration. And when you sell a straddle, you're selling the at the money call or a put. So you're selling the same strike price call and the same strike price put. If you're selling a strangle, you're selling roughly a 35 delta put or a 35 delta call. So let's just take a look at that here for Apple, for example. And I want to show you what it looks like for Apple because you might be surprised at just how far the stock needs to move before a short straddle or strangle starts to really lose the money that you're concerned about losing, right? So if I sell a January 28th, which is roughly 45 days, and I sell the 172.5 call and the 172.5 put, which is the at the money call or put, the stock's currently trading at 172.25. I'm collecting $8 for the call and I'm collecting $6 for the put, which gives me a total collection of $1,400 on a $172 stock. So what's $14 divided by $172 stock? I'm collecting 8.1% of the stock's value in 43 days. So you're collecting 8.1% in 43 days if the stock stays at 172.5, right? And just to put that into context, if you own Apple stock, you collect 87 cents per share per year. So you're talking about orders of magnitude more in terms of income using this type of strategy than you would get from the dividend yield. You're looking at 8% every 45 days. And just to put that into context, right? We know that short selling a straddle has unlimited losses, right? There's no limit as to how much money you can lose. You can only make $1,400. That's the most you can make if Apple pins at exactly 172.5 by expiration. But let's also take a look at how far does the stock need to move before you lose $1,400, because the unlimited risk factor is true, but the stock has to move pretty far before that actually happens. So what we're going to use is our P&L simulator. We're going to actually move the stock up higher. We're going to see how much money do you actually lose as the stock moves higher. And I'm going to try to move my slider until I lose about $1,400. So at about $200 by January 28th to the upside, do I lose roughly $1,400? And just to draw that on the chart here, I have to zoom out pretty far to get to $200. So as you can see, the stock moves from 150 to 179. To get to 200, the stock would have to be up here or higher in order for me to lose the $1,400 that I'm potentially making on this particular trade. I would actually have to go beyond that in order for me to lose more. So $200 is all the way up here. And then let's look to the downside. How much does Apple need to move to the downside in order for me to lose $1,400? As you can see, it's about 144. So 144, whoops. Let me redraw this for you so that I get the accurate projections here. 200 is up here, 144 is down here. So if the stock stays within this range, from here to here, I would lose less than what I can potentially make on this particular trade. If the stock exceeds that trading range, yes, I would lose more, but that just shows you how far the stock needs to move before that actually happens. And remember, the trading range that we're kind of looking at is somewhere between 170 and 180. And historically, we've seen that even when the stock breaks out higher than this, we do have pullbacks here, but they never quite exceed these types of levels. If the stock exceeds these types of levels like 200 and 144, I would hope that you would cut losses before the stock reached those specific levels. Usually when we talk about breaks above a trading range, they're usually a few percentage points and they come back within a couple of days. If you see the stock run up to $200, you can certainly, we'll talk a little bit about some of the adjustment strategies you can make to offset some of your losses or reduce some of your losses. But hopefully this just helps illuminate how far the stock needs to move in order to offset the risk that you're actually taking on these types of strategies. Does that make sense? Please type 2 into the chat window if that makes sense to you. And if you're using a strangle, even more so, right? So what's a 35 delta strangle here? So I'm selling a 35 delta strangles of 182.5 and then a 165. So 165, 182.5. That would be the strangle that I would sell. Here I'm collecting $9.15 on a strangle. So let's just take a look at how far does the stock need to move before I lose $9.15 here, about 146.5. That's down here. So roughly very similar ranges, 146.5. And then to the upside, the stock would have to move to about, $915. That's about 200. So roughly the exact same levels that the stock would have to exceed before my strangle lost more money than the max potential that I have on this particular trade. And with the strangle, I do have a bigger range that I'm going to make this $9.50. As long as the stock is between 165 and 182.5, I'm going to make the full $9.15. So these strategies, I know on the surface, looks very risky. They have the strategies that have unlimited risk, but you have a very high probability of profit and you have a very wide trading range in between where you will be profitable and a much, much wider range between where you won't lose more than what you can potentially make using these strategies. So this is not to tell you to trade these strategies. This is simply to help you understand what trade-offs you're actually receiving by taking on this unlimited risk. And for some of you, you might be open to this type of trade-off. You might be comfortable with it, but usually it's a strategy suited for more larger portfolios. And we also publish a report on this type of strategy. It's called our Straddle and Strangle income report in our hub. In the hub itself, you can go to the Strangle and Straddle report. And what we have here is stocks that give you the biggest premium versus the stock price based on the straddle or the strangle. As you can see, you have stocks that are giving you 10, 11, 12, 13% of the underlying stock's value between now and January expiration in terms of premium. So, and I tend to find that I prefer trading these on lower price stocks. One, if you traded them on higher price stocks, you just need more capital. You are potentially taking on larger amounts of losses potentially. So I tend to trade these on the lower price stocks. So you can quickly use our report to find the lower price stocks like Peloton, like Lyft, $30, $40 range, especially if you're first time traders. I would stick with the lower price stocks as a starting point. So let's just look at Peloton real quick. Peloton's currently trading at just around $40 here. And this is the $40 strike price that collects 19% of the stock's value in just less than 45 days. So let's take a look at Peloton real quick as an example. And one of the other things is that Peloton has recently had a large outsized move to the downside. So this is also potentially a good time from a timing perspective to look at this type of strategy. So a short January 30, a $40 straddle here collects $7.55 on a $40 stock. That is a large percentage of the underlying stock's value. You're actually collecting $7.70. So let's take a look at the P&L simulator. Let's see, how much does a stock need to move before I lose $770? So as you can see here, the stock has to be below $24. This is a $39 stock. So the stock would have to be below 24, which is down here, or it has to be above, $55. So all the way up here. Now, the stock has made a big move recently, so this might not seem like a big move here, but this is really where the stock has to exceed before you lose more money than you can potentially make from the straddle. Or if you look at the strangle, the 35 delta put is roughly the 37 put, and the 35 delta call here is the 45 put. You're collecting $4.50. You're collecting less but I would bet the trading range as to when you would lose $4.50 is roughly the same, $54 or so to the upside and about $25 here to the downside. Actually, a little bit less. $28 here to the downside. That's your trading range from the Strangle. So, either one of these three strategies you can see gives you a very high probability of success, especially if you're able to identify successfully the stocks that are trading within a range. And even though they have unlimited risk, they give you a huge amount of leeway in terms of being profitable and before you lose more money than you can potentially make on these strategies. So suitable for some portfolios, obviously not suitable for all, but I want to make sure you understand the strategies before you make a decision as to what suits your portfolio. Does that make sense? Please type 3 into the chat window if that makes sense to you. Perfect. Okay, so the last strategy I want to talk about here are just iron condors. Now, I'm personally not a huge fan of iron condors in terms of trading them as a single strategy, because iron condors are basically just a put credit spread and a call credit spread traded at the same time. And remember, I was telling you before, once you've identified a trading range, you generally want to wait till the top end of the range to sell that call credit spread. And then perhaps a few days later, when the stock is near the bottom of the range, you might sell that put credit spread. My preference is to sell an iron condor as 2 separate strategies. And you want to be tactical about it. You want to sell the upside when you're near the top end of the range, and you want to sell the downside when you're near the bottom of the range. This helps make your iron condor profitable faster. Now, you don't have to do that, right? You can just say, we're in a range. I think it's going to trade between this and this price. So let me sell the iron condor. That makes money as long as it does that. You can do that, but it just takes longer for you to make your capital because you're not being tactical on both sides. You're kind of just averaging out both sides. Does that make sense? Please type 4 into the chat window if that makes sense to you. So you can trade it as one strategy, but my preference is to wait for a trading range, to wait for the upper bound of the range. I'll sell that call credit spread, and hopefully in a couple of days later, the stock is near the bottom of the range, I'll then sell the put credit spread. And if that happens, likely what I'll do is I might even take profits on the calls and establish the put side. And maybe a few days later, as the put rises, I'll take profits on the put side, and I might do the same thing again. I might then establish the call side again, just a few days later or a few weeks later, once it's near the top end of the range. That's my preference. You do you, but in terms of iron condors are effectively just entering the put side of the credit spread and the call side of the credit spread in a single strategy. If you're going to do it, go out 45 days. We generally like to sell the 25 delta strangle and then buy wingspans that are somewhere between $5 to $15 wide. This way you have a limited amount of risk on the particular trade and you are effectively short the strangle. So you have some of the benefits of selling a strangle, but you don't have unlimited risk. So those are, generally speaking, the types of trades that you can potentially make during a neutral or sideways market. So I do want to talk a little bit about, when we trade straddles and strangles and iron condors, what are the things that you can do to manage these trades? So when we talk about strangles and iron condors, because the strike prices that we're selling are far apart, there are adjustment trades that you can make to it. When it comes to a straddle, there's really not much that you can do to adjust a straddle. You really just have to set a threshold that you're willing to take the pain on. And as long as you're within that threshold, you stay in that trade. If you exceed that threshold, you cut your losses and get out of the trade. So let's walk through this. Let's first talk about strangles and iron condors. So let's go back to my Apple example. Let's take, let's go back to Apple because I think that's an easier example to do. I was looking at selling the strangle here before. I was looking at the January, I think the 165, let's do the 165, 180 strangle here. Now, the stock's currently trading around 172, right smack in the middle of this trading range. So let's say, I trade this strangle, right? And I'm expecting the stock is going to trade sideways. I'll zoom in a little bit so that we can see this. I'm trading the strangle here because I think the stock is going to trade sideways from where it closed today, which is around 172. And I sold the 165, 180, just to illuminate where on the screen where those two strike prices are. 165 is right here, and 180 is up there. So basically, if you sell a strangle, your expectation or what you want the stock to do is trade sideways. But that doesn't always happen, right? The stock will move a little higher, might move a little lower. Now, what happens is that if the stock starts to pierce one of your strike prices, so let's say it starts to move below 165, what can you do? Well, if you sold the strangle here, the 180, 165 strangle, both here collecting about $4 or so, if the stock starts to move lower, the call side will become profitable, right? Something you sold for $4 will likely trade for maybe $1, maybe 50 cents or so. What you can do at that point is you can roll this strike price down closer to the 165s. You can basically turn your strangle into a straddle. So what you do is you close the 180 calls, you buy it back for 50 cents or so, and then you sell a 165 call. And what you do is you turn your strangle into a straddle. And what you're going to be able to do by rolling your 180s down to the 165s, you're going to collect more premium. And that premium that you collect will help offset some of the losses that you have on the strangle. Now, this unlikely will turn your losing strangle into a profitable strangle, but it certainly will decrease the losses that you have on this particular trade and actually allow you to stay in that trade for a little bit longer. And maybe the stock then rebounds back towards that 165 level and allows you to close that trade at a profit. But those are the types of adjustments that you can potentially make using a strangle or a straddle. A strangle. If it starts to move to the upside, you would start moving your puts up. And then if it starts to move to the downside, you can move your calls down. Does that make sense? Please type 5 into the chat window if that makes sense to you. You're basically moving the side that's not tested. The tested side, the side that's losing money, that side you hold on to. The side that's making money, you start rolling that down to collect more premium to offset some of those losses that you have on the short strike. And you can do this for strangles and you can do this for iron condors. It works the same way, whether you're looking at an iron condor or you're looking at a straddle, right? So if let's say I have the 160, 145, 160, 190, 205 iron condor, if the stock starts to move higher, what I'm going to do is I'm going to move my put side, the side that's making money, I'm going to move that higher along with the stock price. So I'm basically moving with the stock as it moves higher. Or if it moves lower, I'm going to move the call side that's profitable lower. I'm going to keep moving with the stock. So with both straddles and strangles, whichever side is profitable, you keep that side moving with the stock itself. So that's how you can trade or adjust and manage your iron condors and your straddles, your strangles, sorry. And then when you're selling a straddle, again, when you're selling a straddle, there's not much you can do to adjust the straddle. You can adjust the strike prices. You can effectively take a loss on the trade and move your straddles to a different strike price. That you can do. But generally speaking, what you want to set yourself is a max pain threshold place. So if you say to yourself, the most I can make here is $1,900, I don't want to take on more than $1,900 worth of risk. So what you do is you set some kind of risk tolerance to say, okay, if the strategy starts to lose more than $1,900, in this particular case, if the stock exceeds $213 by expiration, or maybe before expiration, right? So let's say, as you get closer to expiration, as you can see, the stock has moved pretty far before you see these types of losses, right? But at some point you will see about $1,900 worth of losses at around 212 or so. You set these types of rules. If it exceeds those thresholds, you simply cut your losses and get out of the trade. Does that make sense? With the straddle or with the strangle, is you set these max pain thresholds. It might be 100% for someone, it might be 75 for someone else. You set your thresholds and you want to cut your losses at that point. Does that make sense? Please type 6 into the chat window if that makes sense to you. Perfect. Okay. So that covers what I want to share with you here today. I hope that this was helpful in giving you, an understanding as to how to identify a market that is likely to move sideways. And again, it's very counterintuitive. if you've identified a sideways market, likely it's too late. Use the technical indicators that help you determine when there's an outsized move. After that outsized move starts to show some signs of weakness or pause, those are your best opportunities to trade one of these sideways markets. Doesn't mean that the markets will move sideways, but that is when you have the highest probability of that happening. And then once you've determined that, the different option strategies that you have depends on your risk tolerance, right? For those of you that are new, lower risk, stick to credit spreads. Perhaps iron condors as you leg into them. For those of you with a little bit more bigger risk tolerance, you're going to get more premium. You're going to collect more income. Those straddles and strangles will be able to be will bring you more income selling these types of neutral strategies. So I hope that this was helpful in giving you a better understanding as to how to trade neutral and choppy markets, which we've had a lot in the recent past. And just to thank all of our members for supporting us and allowing us to continue to do this. For those of you that are brand new to us, I hope that you can sign up for a free trial at OptionsPlay.com. It'll give you a free 30-day trial to everything that we have to offer. We send you daily entry and exit signals from our options research team. You have a free 30-day trial to our full platform, which includes the credit spread and the straddle and strangles report that I just showed you here today. And it allows you to join us for our weekly options education and market outlook sessions. This is to help you learn more about option strategies and stay on top of the markets. This is all available to you for a 30-day free trial at OptionsPlay.com. So with that hopefully covers everything. At this point, what I'll do is I'll open this up for Q&A. If you have any questions, please type your questions into the Q&A section, and I'll try to answer questions for a few minutes before I sign off here for today. I see a lot of questions already lining up here in the Q&A section, so let's take a look. I'll try to answer these in order as much as possible. There's a few questions about, can these strategies be traded in IRA accounts? Well, I would say that heavily depends on your brokerage firm as to whether or not they allow that in IRAs. So, that's a question for your brokerage firm. Your brokerage firm determines that. What's the best credit spread selection, big market cap or small market cap? Well, market cap will determine liquidity. So with these types of strategies, you need liquidity, especially with multi-leg strategies. So I always trade the largest market cap stuff before I look at mid cap stuff. I usually stay away from the small cap stuff just because liquidity is not there. Michael's asking a question not related to options, but about the platform that I do want to answer. He's asking, how do you change the colors? You go to your profile. Under your profile section, under settings, you can change your colors. So you can go to light to blue, and then go back to your app. You can change the colors on your platform from dark to light. Do you consider trend momentum prior to determining a bullish or bearish direction? Yes, because after a big move, an outsized move to the upside, you're more likely to see some downside move and vice versa. But we are talking about neutral strategies, so direction is not as important. Wouldn't it be better to add a stop loss? What are the chances of coming back after being down 50% or more? Frank, that's a really good question. And I have not done the research in terms of stop loss levels and what are the probabilities after you get stop loss of being profitable versus losing more. But that is something that I do think we would like to do some more research on and give you some stats around that. But I unfortunately do not have those numbers off the top of my head. Frank, as far as your margins on a short straddle, the general rule of thumb is, about 20-25% of the straddle's value in terms of margin. But you have to talk to your brokerage firm on that as far as the margin requirements for your brokerage firm. Should we consider the 1 month trend when selling credit spreads? I generally do look at the trends when I'm selling credit spreads. You want to have a loose directional view when you're selling credit spreads. So yes, for straddles and strangles, the objective is to make sure you wait till it goes to expiration. Generally speaking, similar to the credit spreads, you generally want to close out straddles and strangles before expiration because these strategies have early expiration risk, and you want to avoid that when you're selling these types of strategies. So we usually have a rule of thumb of closing out these trades about 2 weeks from expiration, somewhere between 2 to 3 weeks from expiration, and closing them out. That will help avoid early assignment for the most part. So Jeffrey, I agree. And this goes back to the first question that I addressed. There's a reason that I would only trade these on very liquid stocks. So when you look at our credit spread file, every single stock symbol that you see in our credit spread file is what we consider very liquid. All of these, you should be able to execute your trades near the midpoint, if not at the midpoint on these trades. So liquidity is something that you can take out of the equation when you're using our credit spread opportunity report. What is the $5 to $15 wingspan? The wingspan is the distance between the outer strike prices. So the distance between 190 and 205 is $15. That's a wingspan of $15. The distance between the 145, 160 is also $15. So that's what we refer to wingspan of $5 to $15. Are these strategies better for high IV or low RV? All of these strategies are better for stocks with high implied volatility rank. So when you have an implied volatility rank that's above 50, that's always going to be a better opportunity for these types of trades than a low implied volatility rank. On a 45-day short strangle, if my puts get breached early, how do I determine if I should recenter both legs early or just move my untested? So Wayne, I don't like to move both on a strangle, because usually if you need to move a strangle, then that means that what you thought was an established trading range is not the established trading range. So you shouldn't just enter another strangle just because you're losing money. That's never a good idea. So in that particular case, you move the untested side. It reduces the overall risk. If the trade keeps going south, what you've done is you've mitigated some risk. What you're not doing is you're throwing good money after bad money. So that's why, I generally don't move both legs on a short strangle. I noticed that if I sell a credit spread in the money, I will get more income. That's true, but selling an in the money put credit spread also increases your risk of early assignment, and also you're not getting as much. You're getting more premium, but you're not getting as much. You're getting more premium, but you also have to get the directional view more right, if that makes any sense. That is my new baby Max screaming in the background. He is a happy child, but he likes to scream from time to time. Is there a number of days to expiration to close strangles and straddle? Yes. 14 to 21 days is general rule of thumb for these in terms of closing out. When would you choose to straddle or strangle or vice versa? So we tend to find that, straddles on lower price stocks, strangles on higher price stocks is usually a good rule of thumb between the two. I like strangles a little bit more because a straddle, you only make the full profit if the stock is exactly at the strike price, and that almost never happens. A strangle, you have a pretty wide range that you're going to be profitable on, and it makes it a little easier to manage. So I personally prefer to trade strangles over straddles. Harinder, that's a good question. It's something that I'll take a look at, potentially adding some type of scan to identify stocks that are potentially entering the neutral market. Does the credit spread reflect the stock's previous price action trend? Yes, it does. So the credit spread report considers what our directional views are, and it only aligns the credit spread with our directional view of the underlying symbol. Where do I look for iron condors in the credit spread list? So an iron condor is really just a strangle with, some the wings, right? So if you look at you can think of an iron condor as two credit spreads, or you can also think of it as a strangle that you also buy the wings on to reduce your overall risk. So to find iron condor opportunities, you can actually use the Strangle report. You can use the Strangle report to find the strike prices that you sell on the iron condor. So for example, Peloton, the Strangle here is the $35, $47 Strangle. So you can use that to construct your iron condor for using the Strangle report or Straddle Strangle report. Yes, wings of protection, that's exactly right. Okay, so with that, that covers the questions here for today. I really hope that this was helpful in giving you that better understanding of number one, how to identify neutral market, and then what option strategies you can trade on the back of that. So with that, thank you so much. I hope you guys have a great trading day. I will be back here next week to review 2021 and talk a little bit about preview of 2022. So I'm really looking forward to doing that last session here for the year before we break for the holidays. If I don't see you guys before the holidays, I hope you and your family have a great holiday and Merry Christmas and Happy New Year. And I'll see you guys in the new year. Otherwise, I will see you guys one more time before we sign off for those holidays. The recording and the slides will be made available to you for this particular session. Look for that in your email later tonight, and you can always look for the recording and the slides on YouTube, on our YouTube channel. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week.